first edition of Whose Brand Is It Anyway? I am Shreyans, VP at the investments team at Fireside Ventures. And with me, I have my co-host Amit, who's a director of finance and investor relations at Fireside. Whose brand is it anyway is basically our attempt in having a candid conversation with entrepreneurs looking to start consumer businesses. And for that, we have partnered with Your Stories, Brands of New India, to reach out to as many entrepreneurs as we can and really share perspective of our learnings across last several years and also the perspective of some experienced founders we have today with us in sharing some of the learnings from their journey across various things. I think last several years, consumer businesses have really been kind of in the limelight and have kind of really taken shape. And what it really means is that building a brand is not as straightforward as just thinking about pricing and positioning. And there are various things that go behind building a brand. And last several years at Fireside, we have made about 30 odd investments and tried to institutionalize some of the learnings from these amazing entrepreneurs. For example, what does it really take to build consumer funnels? How do you target and retarget them? What does it really take to optimize your direct-to-consumer channel, to optimize your e-commerce channels? How do you go about thinking of omni-channel? How do you think about raising debt, equity, etc.? And try to really answer some of the actionable nuts and bolts that can assist you in kind of your journey towards growing your own brand. And that's the whole idea we're coming from. And I'll request my colleague Amit to introduce the founders on our panel discussion today. So Amit, over to you.
Thanks, Shans. I think as we were thinking about the fundraise process and we thought we'll give our perspective to the budding entrepreneurs, what we also realized was who better than some of our own portfolio founders to give in their perspective. They've lived through this on several occasions. And hence we have with us Priyanka Salot, who's the founder of the sleep company, India's first comfort tech company. And we have Siddhartha Nangia from Smytten, who's solving sampling for D2C brands. I think welcome Priyanka, welcome Siddharth. Right, both of you started your journey with a very unique proposition, almost first of its kind in India. But what was not common was that Priyanka, you bootstrapped almost about till the time you raised funds from Fireside. Siddharth, you raised rounds from angel investors, seed funds before reaching a particular scale and reaching out to Fireside for your fundraise. Yep. I think that for us, we thought would give a good nuance to each of these founders who are watching us today to realize how to go about this process. And when we think about fundraise, there are 4 to 5 key aspects. One is what kind of capital is available in the market, right? The second is how much capital one should raise, when one should raise this. And once you figure these 3 things out, how do you go about doing this and what you should be prepared for when you're trying to raise this capital. At the very core of it all, I think is the question of whether one should even raise external capital and how does one go about evaluating this. I think when we were discussing, Shreyans had a very good perspective on this. Over to you, Shreyans, to give some thoughts.
Thanks, Amit. I think I'll add a VC lens to it. And then given the founders have really done it differently, it would be really helpful to learn from their point of view as to what was their thought process. See, I think quickly on the VC part of it, one thing that has become a little bit synonymous with fundraising is the glamour and the association of it becoming a barometer of success. As a VC, I think it is our kind of responsibility to tell you as a founder that fundraising by no means is a barometer of success. You can run a profitable venture and be very successful, and there may be no need for you to raise a capital. And therefore, I think one of the frameworks that I would suggest that founders kind of think about while raising capital or not raising capital is typically the companies come out at this stage and need capital for growth, right? That's the primary use case amongst various other things. And if you are in an industry or if you are running an enterprise which actually may not need that much capital for growing 20, 30, 40, 50%, right? And your profits are self-sustaining and your growth aspirations are being met, it may not necessitate raising external capital. So it basically boils down to first principles, which is A, do you really need capital? B, do you understand what it comes as an expectation from third parties when you raise capital, and what is the cost as a founder you are bearing in terms of dilution and your overall wealth creation, right? So I think this is a little bit of pre-context, and I would maybe request Priyanka to start, who kind of literally bootstrapped it for a while before raising capital. So Priyanka, what was it that was going on in your mind, and what was the decision-making framework you used to think about whether to raise capital or not raise capital?
Yeah. So hi guys, hi everyone, hi Shreyans. So Shreyans, as you said, I absolutely agree. There is no yes or no to this, right? Nobody can say one should raise a capital or one shouldn't raise a capital. It is a function of each business and the vision or the aspirations that founders have. Right. For us, as you correctly said, for the first 1 year of our launch, we were bootstrapped, we were profitable, and we grew the business to a scale. Right. The reason and why did we think of raising the capital, after 1 year, right? Was, it was very important for us to, one, be confident that there is a product market fit. Right, I think that was very, very important, that we were solving a consumer tangible gap and a problem, and hence after a year we realized that there was a product market fit, which gave us the confidence that the vision that we have, that we want to make the sleep company a global comfort tech brand, right? We were confident of achieving that, right? Once I think that happened, and the aspiration that both Harshil and I have is we want to make it a global brand, right? And that's what exactly, as you said, if there is a certain business and to drive that exponential growth, since you're coming as a challenger brand, right? Really challenging the incumbents in the market. If you need capital, if actually you need capital to drive that growth, is the only time you should raise capital. Right? And after a year, one criteria for us was that we realized we wanted to grow much more faster and exponential, and we needed capital to fuel that growth in a sustainable way, right? Growth, people, capex is what we wanted capital for. I think the second most important thing also was that after 1 year, we wanted to make sure that we can learn from other people in the ecosystem, right? That could be other founders in the ecosystem, in the consumer, because we are a consumer brand, we are a D2C consumer brand, or VCs who have invested in companies who are in this ecosystem, right? I think that became a very important criteria for us as well, to decide that we want to raise money so that we could get access to knowledge, we could get access to the resources who can help us through this journey to achieve the vision that we have and the company could achieve, right? So I think that was the trigger which made us say that, okay, now is the time to raise the capital, and not before that, right?
Got it. Wonderful. I think a very interesting perspective, Priyanka. So Siddharth, I think you decided to kind of raise a little bit of angel. And what was the decision kind of you had to take at that point in time? What was going on in your head in journey of Smytten? If you can share some lights for entrepreneurs listening in today who can learn from your experience.
Sure. First of all, thanks a lot, guys, for getting me here. Hey, Shreyans, hey, Amit, hey, Priyanka, great, interesting story of yours. Very different in our case, actually. So just a bit of a background. I was with Unilever for more than a decade, left UK, came back to India in late 2015 to start Smytten, along with a very good friend of mine, Swagat Sarangi. Swagat also was head of marketing Google, and then we were starting this, right? Earlier thought was to keep it bootstrapped. And as Amit said, we were getting into something that was completely new. Nobody had done this in the country before. While Swagat and I were super confident, as every entrepreneur would be, but we wanted to see whether there's actually value they were going to create in the market. So after we came back and started this in August 2015, we were speaking to some of the CMOs and all those guys for the next 2 to 3 months, trying to see we get it right as early as possible. That was the thought. And when we started discussing, we realized that in every discussion, and just this entire funding thing was becoming a bit hot at that point of time. And people started asking us questions, do you need money? And do you mind if I invest a small amount of money into it, right? And that's how this whole thing started. I'm very open and candid about this discussion here. There was no plan to raise it. Swagat and I had put in enough capital initially. We said no for 2 months while we were discussing with people. This was till almost around October. But during this time, we realized because we wanted to be a tech-heavy thing, and that was expected to be expensive. So that's when we said, if typically there's a money on the table and we know we want to build something very confident about it, we know we are heading to. So we actually raised our friends, family, angel round even before the first order. That was, and though it was small capital, now I can say small, at that time it was very big. It was a 2 crore that we raised at that point of time. But the important part there, as Priyanka also said, for us, we wanted senior people from the industry to be with us in something that we're trying to build, which was completely new. So that's how the journey started for us. And that's the reason we raised whatever we raised at that point of time. But on the hindsight, if you ask me, if I had to do this again, will I do the same thing? My answer would still remain yes to that. Because those two CR actually gave a hell lot of confidence to us. Because again, going back to the tech side of it, I think otherwise would have underestimated the amount of money it needs to build a tech platform. That's number one. Number two is, yes, we would have compromised in few places that we didn't. Number three, I think, especially from people who have been in the industry for a while and they have their own commitments otherwise as well to do. And yes, the reality is when you're taking this calls of becoming an entrepreneur, you need your family to be with you all the time. And me with 2 kids, Swagat with 1 kid, we want to like them to do what they are doing without changing too much at their end. At that point of time. So this, everything, if you had to give 100% to this business, those things did help us at that point of time. So this is how the whole thought process was, Shreyans, when we started this off.
Got it. Very interesting. I think one common thread, if I can take out from both of your conversations, appears to be really identifying the use case, whether you really need it and it's going to solve a particular purpose for you. I think that's something that probably, listening to us can take it out.
Shreyans, I would just like to add one more point, which I think is critical as new budding founders should also think about. As you said, today a lot of people have started thinking funding as a success metrics or it's the glamour, right? Yeah. I think as budding founders, my one thing would be, I think they should stay away from it. One thing is, sometimes it feels like that if I get money early on, the chances of success could be higher. But I think they need to understand that what you're also doing in the process, the earlier you raise money, the more dilution you do over the time frame, right? So I think it's very, very important to even understand that aspect for, entrepreneurs to really take a decision, what is the right time to, raise money.
Well said, Priyanka. I think very important consideration and a nuance for founders to consider. And I think we should dive in a little bit deeper into that.
Yes.
But first, I think let me ask, one question, which is kind of just flowing from our flow of thought, which is one, if you are saying, should you raise capital or not? The next logical question is, what are the types of capital that are relevant to you at various stages of businesses, given that now we are in a little bit more mature ecosystem and various sources are available with various nuances. So let me hop on to Amit to add a little bit perspective here. Amit, given you worked across asset classes in early stage and late stage companies. So what would be your kind of, if you can throw some color on, this topic of what are the various types of capital available today for various types of companies. And then, we'll kind of come back to Priyanka's question.
Sure. Thanks, Shyam. I think before I answer what kind of capital is available, I think what's important to understand is kind of stages a company goes through, right? And I'm more looking at it from a consumer brand lens, and it could differ based on the industry. I think typically a company starts at a very seed stage where there's a germination of an idea, there is a paper plan for execution, but you've not really had any product, you're not gone into the market, all of this. The second stage could be, very early stage. You sold some products, there is some acceptance in the market, your unit economics are coming together. Third stage is early growth stage. You're doing about 40, 50 crore of revenue, and your unit economics are now completely strong. Your brand has found acceptance in the market. The next stage would be probably when you're doing about 200 crore of revenue, you're now a very large brand. All your initial target market has accepted you, and now you're thinking about expanding to larger geographies, expanding beyond your initial product line to other services, other products, etc. And each of these stages now obviously means there is different risks at each of these stages, right? And hence the kind of capital which is available at each of these stages completely differs, and the cost of that capital differs. Let's say the seed stage, right? You still don't have anything on hand, and hence the person who's putting in money at that point in time is taking the highest amount of risk. That could ideally be your family and friends, right? Who are ready to partner with you, help you, support you through this process. And along with them are today a lot of angel investors who believe in the whole entrepreneur ecosystem, the startup ecosystem, and they are ready to support that. The next stage, when it is early stage, I think you have now institutions coming into play, more niche, more focused institutions trying to scale particular kind of sectors, and with expertise in those sectors, trying to build those sectors and the companies in those sectors. And along with it, you have debt in form of revenue-based financing. It comes at its own high cost, but you still have an additional route of capital now. The next stage, definitely, which is early growth stage, you have now venture debt companies following you, slightly lower cost of capital than a revenue-based financing. And there are many more investors now, institutional or otherwise at this stage, because the risk appetite at this stage is the highest, right? The next stage, at the growth stage, you have very niche, very large institutions who are ready to back you with large amount of capital and an expertise to take you from that to almost about an strategic acquisition or an IPO kind of a journey, right? When they have found your brand to be very valuable. I think this takes me to the next point that, when all of this capital is available to you, what do you really consider while taking these capital, right? For that, I think what is important to understand is, in terms of venture capital, what is the origination of a venture capital? Way back in 1950s, when venture capital started in the US, it was really called liberation capital. What it did was liberated the founders and the companies from the shackles of limitations of capital, limitations of bandwidth, limitations of networking effect, and the limitation to power to negotiate with your suppliers, with your customers, all of that. And once the capital is infused in these companies, now you are empowered to take this to the next level. You can grow much faster than you originally could ever think of, right? And hence also with any kind of liberation comes in and governance to really protect this liberation, right? From being misused or even protect the whole investor who's bought into this company. And hence there is this whole institution building which happens, which is basically led by a board who will now start taking decisions. It will not be founder led, but then again this board is trying to get this company to the next level, so they're not going to be holding you back but only helping you to get there. They're going to bring in their whole network effect of their whole expertise in building brands. Like for Fireside, for example, right? We've, as an organization, built in a team which can bring in value to brands in various aspects. Today, we have expertise in go-to-market strategy. We have expertise in D2C brand building. We have expertise in organization building, fundraise, including equity, debt, all of that. And we back all our brands with this expertise. So that is what becomes available to you. But all of these availabilities comes with certain amount of restrictions and responsibilities, like any kind of power in life. And one founder should be aware of, these responsibilities, because this responsibility is what will take you to the next level. And no company overnight reaches IPO strategic stage. And this is not any bad point to start off on building that institution. I think once you have these considerations, I think most important thing from here on is to understand how much capital to raise, right? And who to raise this from. And I think I'll request Shreyans to throw some light on that.
Thanks, Amit. I think it's really the question of dilution that kind of really needs to be addressed on when you think about what is the quantum of capital and whom to raise it from. I think let me add some stuff and then we can kind of request Priyanka and Siddharth to share their perspective. See, from the perspective of raising and thinking about what is the right quantum of capital that a founder should consider, it really boils down to, a sort of a framework, which is, let's say, the length of the time you need to raise capital for versus the bandwidth you are willing to allocate in frequently raising capital, and B, the timing which impacts your dilution to an extent, and the market conditions, right? I think these are the two basic things that, of course, there are various nuances and things that matter to individual businesses, but broadly speaking, if you can think along these two lines, right? And let me elaborate a little bit. For example, think about your business, right? Ideally, if you are raising capital for the first time, our suggestion would be that you raise capital for at least 12 to 18 months so that you can focus on your business and build it out. And how do you know what does that mean, right? So in very simplistic terms, I mean, we have all sorts of fancy terms calling it free cash flows, etc. But what it simply means is that if you envisage your growth over, let's say, 18 months time and jot down three things. A, what is going to be the expense that is going to be incurred in kind of getting to that stage, which primarily for consumer businesses is performance marketing as well as team building. And second, understanding, the working capital, which many people kind of ignore. A lot of consumer businesses take up a lot of working capital, and you should budget that early on, given you're very unlikely to be able to raise debt to support it. If you add these 2-3 points up, you'll get to something which we call as free cash flow for that 12 to 18 months. And I think that is somewhere you can start off as a figure in your mind to think of how much capital should I raise. Now, when it comes to raising it from whom, I think there is a point of hygiene that needs to be considered first. Many entrepreneurs, may not like to raise capital, may not want to kind of go and pitch in their story and explain to everybody as to why, their business is better than their peers. What does it really mean in terms of, the numbers and the financials, and what it would mean for the other person to invest behind you, right? And therefore, if you are not comfortable or you don't want to do any of this, there is no harm in going and seeking professional help and taking an advisor or a banker to help you do it. Simply put, getting to a connect of venture capital fund or venture debt fund is very easy in these times. We are all socially connected. Only thing that I would suggest doing it is list down the companies that you want to target and identify the right people who you should reach out to. And don't shy away from cold calling. Almost everybody is, years in this ecosystem is trying their best to help and listen to each other. So there is no harm in cold calling. Obviously, if you have a mutual connect, I think that's the best way to go about it. But let's hear from, the founders as to, what was going on in their head when they were thinking about A, how much to raise, and B, whom to raise it from, right? So let me start with Siddharth this time. Siddharth, what was going on in your head in answering these two questions?
Yeah, okay. So I would say there's not an exact answer to this because it depends on the stage. I think Amit rightly explained earlier. The stage you are in decides multiple things as you go along this journey. For us in specific, I would say after that angel round that I spoke to you about already, after that, in these 5 years, we've learned a lot. And the first thing that we learned that there are only two parameters we are looking at when we are looking at the institutional investment. One is the amount of money that will be there, and second is the valuation. That's how the mindset works. But after having those 5 or 10 discussions, we realized that we are missing a very, very big third angle to it, which is whom are we raising it from? Because when you get into it, when you get into the VC circle, and if you're new to this entire entrepreneurship circle, you don't realize that the most important actually is the third element of it. And that is, we realized after having spoken to those 10 people that if it's, see, mine is also an arranged marriage. And today, again, it's a successful arranged marriage of mine, right? That's the way it should be seen when you're looking at whom you're raising it from. It's not, it is, while we as an entrepreneurs looking for fund, at the same time, there are fund managers looking to invest in the right funds. And if you don't get that mix right, it can actually create a lot of trouble. And that was very, very evident in few of the discussions that we were having. So after those 10 discussions, Swagat and I were very, very clear that yes, while we know how much to raise, and that thumb rule shares exactly what you have said. Initially, we had said 12 months because we realized that the amount of time it takes to do this entire discussions takes away a lot of what we actually want to do. So that's the thumb rule we have always followed. Earlier it was 12, now it is 18 as we have grown. That's the way we have gone about doing the business. Now the element that was left was whom to raise from. Then we did this whole process of shortlisting because we were getting into something that was completely new. Nobody had done this before, number one. Number two, if you're getting into a place of FMCG, let's face the fact that while there are many VCs, not everybody, sorry to say this, but not everybody understands the FMCG business that ideally the way it should be understood. Nothing wrong in it, but that's how the industry gets. So we had to get into and talk to people who understand what we are doing and start valuing what we are doing. Because while Angel Round had helped us to do this entire market fit study according to us, but to go around and tell the story, the same story, and a lot of times getting diverted doesn't make sense. So then we shortlisted some 7 or 8 people whom we'll speak to, who have either invested in this industry or have a background in this industry, very strong background. And that's what we went around going this, when we started this journey with this whole process of shortlisting and then going about it. And then, yes, I already said that about amount to be raised. Initially was 12. Today, as we speak, it is 18 months.
Got it. Priyanka, what was going on in your decision making?
Yeah, and Shreyans, I'll take that question for both the stages that we're raising funds or we've raised funds, so that people can also understand the difference. And let me talk the last stage, which we raised a year back with Fireside Ventures, right? I think there were 3 things that we were thinking about and we didn't have the answer, right? The first stage, as you said, how much to raise. When we started the journey of fundraise and talking to people, we thought we'll raise for next 1 year and that's what we need money. But after you start talking to a lot of friends from the circle of other VCs in the circle, that thinking evolved. And as Siddharth also said, you don't want to be in a stage where after every 6 months, you're worried about raising money, right? So I think that thinking evolved during the process itself, where we said that we should look at least a 12 to 15 months of horizon, right, and not shorter. And your business plan is what would tell you what that amount is. Taking care of obviously the money you want to spend on driving growth, on people, if certain capex or working capital, right? That's are the things that you would take care, bifurcation of how much money you want to raise in. I think once you're clear on the money you raise in, to what Amit said, for every company, there are different stages of growth, right? Last year, when we were trying to raise money, we were in the early growth stage, right? And that there are certain funds that would invest in companies which are in early growth stage. So the next step was very clearly list down the list of funds who invest in startups who are in the early growth stage. Once we had that list, I think there were 3 important criteria for us and shortlisting who we want to talk to, right? First, I think as Siddharth also mentioned is, we are a consumer brand. We wanted to partner with people who understand consumer brands, who understand what we are trying to build, because it's not just about money, right? You're going to be in a long-term relationship with the people, and it's important that your investors understand and appreciate the vision you have, right? Otherwise, it's going to be conflicts across the journey, which nobody wants. Right. So I think that was very important. List of VCs, early growth VCs who understand consumer brands. Right. Second, which was also very important, as I said, there are a lot of VCs now you will find who invest in consumer brands, right? Then I think depending on founders, there are criteria. We actually both Harshil and I, we came from IMCal and we had a huge alumni base. Right. The second step we did, we reached out to our alumni base, and it is surprisingly amazing how much people help you. We got all introductions through to VCs through our friends and our alumni base, and feedback of what kind of value add can each VC do. Right. There are certain VCs who will give you the money and will leave you. Okay, go ahead and do what you want to do. Then there are funds like Fireside, and I think that's amazing about Fireside. They are literally, as you said, they have this ecosystem of knowledge at different stages of your business, of your go-to market strategy, what works in digital, giving you access to those resources. So that became very critical in the early growth stage, because that's what you want, right? So I think the list of the VCs, figuring out who are the kind of people you would also like to work with, right? As a founder, I think that's very founder specific, that what kind of people you want to work with, right? I think that became a second thing. Third is, to me, actually a minor point in the early stage, but yes, important, is obviously, what kind of valuation you get, right? And how much are you diluting? There are certain VCs who would come only at, let's say, X% of stake, and maybe founders don't want to dilute that much, right? So I think those were the criteria that played in, that who is the right partner at this stage, given the ambition of growth and learning from your partners, right? I'll tell you the little bit different as we did it this time, right? This time we are in a growth stage, so we are looking at growth stage. We looked at growth stage investors, right? Here it became important for us, one criteria which was not the criteria in the last round, became very important. Who is this investor who can keep on supporting us in future journeys? So obviously the check size you're looking is more, right? And that, let's say if you have a vision of next 5 to 7 years, and that you would want to raise another round after 2 years, you want to have partners who can financially, one, support you across your future rounds, if you don't want to bring too many people on the cap table. Right, and which I feel is very, very important for us. We want to keep the cap table very clean. We wanted very few people who understand our vision and can keep on supporting us in this journey. So I think that was one difference. Obviously the list changes as per the stage where you are, as Amit also said, but it also becomes very important for us, people who can now support us in this future continuous rounds. Second thing is, for us, for the sleep company, two things which are very important in this journey. We are going international and we are going omni-channel, right? So at this stage also, the criteria that stays one same is, we still want investors who understand consumer brands and who can add value, let's say, in these two journeys that we want to go in, which is international as well as offline. And that's how we selected kind of this investor, and which is little bit different from how we went the first round.
Got it. Very interesting, Priyanka.
Just to give some perspective on even the debt angle to this, right? Debt plays a very complementary role to this whole equity capital. Debt supports and working capital and your capital expansion. Now, cost of equity is pretty high, right? While all of the support is available, you will cause dilution to yourself when you're raising equity. When you support it by debt, then and if it is meaningfully negotiated and is able to extend your runway. Just to take an example, let's say you're a 100 crore revenue company and trying to raise another 100 crore at a 5x kind of a multiple, you will dilute yourself by about 16%.
Yes.
Right? Now, let's take an example where you're raising 30 crore of debt and almost using it capital efficiency of 2x sort of thing. Now your revenue is about 150 crore. You are able to extend your runway by 3 to 4 months, where it's reaching 150 crore. Now you're raising capital at a 750 crore valuation, pre-money valuation, and hence diluting only about 11%. Now you put all of this math together, you've spent in interest cost about 5-6 crores, and you've saved yourself about 40 crores in terms of revenue, in terms of your valuation. Which is like crazy number, right? It's a 5% dilution impact just about extended by 3-4 months of this thing. So just to summarize, I think if you are able to grow at a rate which is higher than your cost of debt after considering a runway, I think you should consider raising debt very meaningfully along with your equity.
Yeah.
Absolutely, Amit. Sorry, Priyanka, carry on.
No. So Amit, I completely agree. I just have 2 add-ons. So completely agree, and that's what we did, right? We raised debt. But I think 2 things which is very important as you raise debt and the way we look at it, right? I think one is when you want to raise debt, one thing that anybody would also see how much equity you have raised as well, right? So the percentage of debt you can raise is also dependent on the percentage of equity you have, right? So that's why it also becomes important that to sustain or to, how long can you pull your runway kind of a thing. Second, the way we look at it, we think of debt to be funding our working capital, right? So that we are not diluting equity to fund the working capital, but we are using the equity, or we are diluting equity to fund the future growth. Right? But I completely agree with you that founders should strike a balance and see how they can balance out debt versus equity to dilute maybe as less as possible.
Absolutely.
Yeah.
So that you were trying.
No, literally the working capital thing I was trying to say that we hadn't done debt so far. The reason we are looking at debt now, primarily 2 reasons. One is, yes, the growth that we are seeing and we foresee right now is going to be significant, and that for that we need working capital support, and debt I think is one of the best ways to do that part. Second is, and again that's something that people should consider. If you're trying to do something big, and that is for whatever reason you think might need some more time than what you had planned for earlier, and doing that big can lead to a large, significantly more value for everyone on who has supported you so far, go at least consider debt at that point of time.
Got it.
And that's what we are looking at. I know some of my friends have also done the similar thing. And omni-channel in case of Priyanka, if that goes big, probably the best time for her to consider as well in doing it.
I think one more important perspective, just from a dilution point of view and closing the chapter on the quantum of capital, I think one thing that we have observed across some of our investments is that, see, if you're a consumer brand with a reasonably high gross margin profile, you'll probably end up raising capital 3 or 4 times before your business is on autopilot, right? And one thumb rule could be that try not to dilute more than 20% in each of these rounds. And if we do a back of the envelope math, what will end up happening is if you raise 4 rounds of capital, not diluting more than 20%, you will still end up owning 40% of your business when it's on autopilot. That's a very healthy number from your eventual wealth creation. Also from the perspective of you owning a meaningful skin in the game and controlling the business, right? So that could be one also thumb rule to kind of think about dilution along with various other nuances. And to be honest, I think raising capital when you don't need it is the other angle that I would add, and not waiting till the 11th hour to raise capital is something that is very important to consider as a founder. So with this, I think we kind of now we've been talking from a position of having the benefit and luxury of raising all kinds of capital, how much to raise, not to raise. But I think we are hearing from a lot of founders who are a bit anxious and curious as to the macro.
Shreyans, before we move to the other one, just one point to add here was one very, very critical element I think many people miss in whatever discussions I had with them, the amount of time and the team involvement that happens in putting a plan together. Because how much to raise, when to raise, completely depends on what you think is going to happen over the next 12 months or 18 months. And within that, being entrepreneurs, we are very ambitious, right? I think we underestimate a lot of things while going through. So you always need somebody in the team as a speed breaker and try to show you the mirror and say, no, these are the costs, and keep building buffer wherever you think things can potentially go wrong. Things are not going to go right for sure. And what you don't want is you have thought of 18 months as a runway, and you're suddenly sitting after 7 months to I'm out of money next 3 to 4 months. And that has to be avoided completely. And for that to happen, the amount of time that has to go in planning and the whole process has to be a lot more streamlined, a lot more thought has to go behind it. And I think some of my friends at least have gone, I wouldn't say wrong, but probably that's where they struggled after a certain point of time. And I think this is where good investors play a significant role. I think we went completely wrong 3 years back in estimating our tech resource cost. But today, this is where we have got it right with help of Fireside and stuff. And good part here is going back to the point, people have to be from the industry, from in the investor angle. Because to somebody else, if I say we are paying probably 2x of what founders are getting, they'll be off their chair. Why are doing it? But somebody like Fireside understands what value that person is going to bring on the table. And hence, it is a right decision. You need people who give you a jerk or a kickstart immediately. And if for that you have to shell out a bit more, so that. And if that releases founders time to do something bigger, more strategic, so that. And those calls, I must admit, something that Swagat and I were not looking at initially. But in these discussions, it was tough. It was tough. I must admit, it was tough to pay big salaries, big checks to people. I would say a year or 2 years back, but this has completely changed right now. We want right set of people. And if market is there, so that be. If they can bring me that much of value, if business can grow 3x than what it is, so that be. That's the whole thought process that happens in those discussions.
Wonderful. Thank you so much for the kind words, Siddhartha. I think very...
no, that's a reality. Amit was part of the discussions. Others too pushed us so much, and we kept saying, no, we'll achieve it. Said, okay, just think again. Okay, that's what has happened.
Got it.
Thanks, Siddhartha.
Wonderful. I think let's kind of come back to the question of what is it really that is happening today, right? And all the talks about raising capital from whom, not from whom, how much, etc., also has to be seen in the light of the market conditions. And there, I think we are hearing a lot of entrepreneurs being a little bit more anxious, not having the right answers, etc. So I think both of you have raised capital in the recent past. And before I kind of go and to ask each of you what was kind of going on in your mind vis-a-vis your perception of the environment, right? I think let me add in what we saw and what we are seeing so as to kind of give the entrepreneurs a feel of how we are seeing about writing, or partnering with more businesses, investing more, etc. See, I think one point that has come about is that the markets are tanking and it is kind of impacting late stage investors, which kind of literally goes back to a little bit of waterfall to an early stage, right? It impacts their exit, as Amit was explaining earlier, right? Venture capitalists typically end up raising capital from limited partners, and therefore they also need to think about returning capital. So therefore, exits kind of play up into the mind. Now, why are the markets crashing? It's anybody's guess. Our key reasons could be the geopolitical tensions, the pandemic-led constraints, high interest rates in the markets globally, which is kind of pulling in all the foreign capital and kind of, impacting our valuations, so to speak. But also kind of, big distinction happens in kind of business that you are running. If you're running a business which is extremely a high burn, unsustainable business, you may have gotten a very rich valuation a year ago, a couple of years ago, and this keeps happening in cycles. And now is not the time when probably you will be able to get that valuation. But it's important to understand that there is no dearth of capital today. If you're running a sustainable business with the right economics and the right path to economics, there is enough and more dry powder that is out there, enough and more companies willing to fund you at the right valuations, right? And a few days ago, some numbers were kind of thrown out in the market. Some 70, 80 kind of India dedicated funds have raised $8 billion to invest in the Indian ecosystem. That's a huge amount of capital. So as a founder from a VC lens, I would suggest that you focus on the business and the fundamentals and not worry about being able to raise capital too much, because this is a cycle which will keep happening, right? And so this is our perception. And we have, we are not kind of, at least from looking at consumer businesses, we are not slowing down in any form or fashion. We are very happy to meet great entrepreneurs with great businesses, etc. But let's understand from, both Priyanka and Siddharth, who have been in the market in the recent past, as to what was their perception, what were the things that were going on in their mind. Should you raise, should you not raise, should you raise more, should you raise less, should you even only focus on business, should you cut costs, various things, right? So maybe Priyanka, if you can go first as to what was your perception of the current macro and what would be your advice to entrepreneurs looking to raise capital?
Yeah. So, Shreyans, as you said, a lot of people are asking what's happening in the market. Is the funding drawing down? Have the number of investments slowed down, or is there, the momentum slowing down, right? So, yes, there was a frenzy over the 2 years of COVID, right? Like the number of deals, the number of money. You heard so many people getting funding, right? Yes, I think that maybe has come down. But what hasn't stopped is businesses that have genuine moats, businesses that look sustainable, and businesses that are trying to solve a real consumer gap still are getting funding. Right? So that's why it's very, very important for founders to understand that you're really building a business for, let's say, a consumer business for the consumers and not for the investors or raising money. That's very, very important, right? If you are clear on what is the moat your business has, how you have a vision to deliver a sustainable business, not just on top line, but even on the bottom line, that's important, right? So I think that too. So as we were looking at this round, what was very clear that we were very confident that we have a business that we believe, and we've proven it at this level that we can continue to grow this business, and we have very clear competitive moats. For the sleep company, we have our own patented technology, right? We've seen the product working wonders. So we were very clear that this is the moat we have, and we want to build $1 billion business in the next 7 to 10 years. Right? That's why for us, to be honest, there wasn't worry of that will we be able to raise money or not, right? That was the first thing, and that's why we were able to filter down to, let's say, a list of investors who come at growth stage. Right. Second was now how much we raise, right? And I think everybody said this multiple times, Siddharth, you, Amit. I think raising funds after a while is a lot of investment by the full team in terms of time and effort, right? Nobody can go through, genuinely, nobody can go through this, let's say, every 6 to 9 months, right? If you're trying to figure out my valuation in 9 months will grow up and let me raise only this much right now, I don't think that's the right way to look at it as per my perspective, right? I think it's very, very important that you strike a balance, and you have to look at this stage for at least 18 to 24 months, right? Because you want your focus, your team's focus on building the business and not raising money every single time. All right. So we were very clear that we want to raise money for 18 to 24 months so that we don't have to worry in future, right? So that's how we figured out that how much we want to raise money for, because we don't want to be in the market every few months wasting everyone's time.
Got it.
Right? And that's how we reached investors. However, one thing that I want to be very clear, let's say when you look at this stage, right, in the current market, it's very, very important. 2 years back, I would still say, investors or everybody in the community was taking decisions to invest, I would say, much faster versus today. Today, I think one has to be very, very clear that you are able to prove that you have a business which is sustainable and which is, as I said, it's a really consumer-driven business.
Got it. And Siddharth, what was your perception of the macro, and what would be your advice to entrepreneurs looking to raise now, not raise now? What are the various nuts and bolts one can think through to really internalize this macro?
We'll be completing 7 years in November this year. We have raised 5 rounds of investment in it, right from seed to angel to pre-series A, series A, series B. There's been not a single year when I've not heard it's all drying off. It's not a single year. Yeah? I've heard the same thing every year. First year, yes, there was my palpitation, my heartbeat was slightly higher. Today, I tell my team, if they ask me this question, I said, the way we want money, there are enough people in the market to put money on you, as long as you do things in the right way. As long as you can show there is a clear path to profitability, as long as you're sticking to your plans that you've already envisaged to. So if that is all happening, don't worry, money will come. So money is not something which is going to drive everything off for us. It is something which will follow if you're doing the right things in the team. So pretty much agree with everything that you guys have said so far. The only thing which I say here, in this round we raised 100 CR. You would know that, I'm sure. So yeah, original plan was to raise it close to around 60-65 CR because that's what business needed. And whatever the plans we had finalized would have been good enough for us. Yes, we ended up raising another 25-30 CR more. that was one thing that we did because two primary reasons. We could see there was demand from the market to put in money. Yeah, that was one. But more importantly, there was something at the back of our mind that we don't want to have this discussion again for next 18 months. I'm very clear in that space. So the only two reasons. There was no reason to say it's winter, it's drying, be worried about it. No. Just go and do what we are doing. We have done enough over the last 6 years to prove at least to ourselves and people who have trusted us to take it to this path. Last part of the whole story is going back to my own point of choosing your VCs whom you are partnering with. If they believe in what you are doing, you'll never be short of funds. Now, whether it is early stage, mid stage, growth stage, I don't think we should worry too much about it beyond a point. If the right set of VCs, as we are growing, even VCs are growing.
Yeah.
And they would never be away from backing you or getting you the right into the ecosystem to fund you. So that is one thing which people should take off their mind. But as long as they can focus on, completely agree with what you said earlier. I think whole funding has been just too much glorified. As a whole stuff in PR and all that thing. Sorry your story, but that's a reality. But it's just too glorified. It is something that is required. It is the right thing to do. But it comes with a hell lot of responsibilities. It just gives a lot more confidence to everyone who's doing it.
Thanks.
Just to add to that, Shreyans, even though there is enough dry powder in the market, what the messaging in the media and all of that has led to is there is slowness now in deployment, right? And also, I mean, there's been a lot of correction in Fed, RBI rates, and debt capital has been raised a lot in the last 2 years by, let's say, venture debt companies, NBFCs, from the VCs, some of these occasions. And there are a lot of government initiatives as well to support MSME startups, right? And with this, debt is also now available at a much larger scale. So one way to mitigate this slowness, I'm not saying that there's dearth of capital, but at least mitigate this whole situation of you being in middle of a fundraise, trying to conserve cash, is by raising debt at the right point again. Because finally, as I said earlier, it is complementary and now it is more available than ever before.
Got it. No, wonderful, Amit. I think so far, I think we have tried to answer all the questions. Should you raise? How much to raise? Whom should you raise it from? Is the market even allowing you to raise, etc.? But finally coming to the closing of the chapter is how do you deal with the other party, right? How do you deal with the investor if you are a founder in terms of negotiating? And then there is a long drawn process of diligence, which Priyanka has been kind of educating us all about. So I think let me start with Amit, who actually on our behalf kind of negotiates with all our founders, and really understand from him, where is the VC coming from? What does it? Why are we asking for? What are we asking? And how do we kind of strike a win-win so that businesses can thrive and VCs can adequately fund it for a long period of time? So Amit, over to you. How do you negotiate? What do founders need to keep in mind?
Amit, I'm keen to listen to that. You're a hard negotiator, I know that. So. What was in your mind when you're doing that?
From the other side.
Wow. Yeah. Actually, I was going to put this across to both of you because I have seen a lot of this from my angle. I've always kept thinking how the founders think about it when they are negotiating with me. But let me start off with how the VCs think about it and why really we think about it in that way. I think before all of that is just to understand what VC capital is, right? This is a fund manager with a certain set of expertise built over several years who has raised capital from external sources, trying to deploy in a certain set of companies and promising certain return to his investors. Now, obviously, with this, he or she sits on a fiduciary position where he or she is answerable to the investor, right? With this comes a responsibility to protect that money, and also in terms of it is not a protection from risk, right? The risk is what all of us have bought into, but we really believe in the idea. It is a protection in a situation where there has been a very good outcome, but you are not shortchanged, right? Or a situation where the capital which you have infused is not being misused, right? Both of this is what we are trying to protect. And hence there are two stages when we try to protect this. One is obviously we've done some amount of business diligence, etc., wanting to put in money into the company, but we want to diligence just to find out whether all of these facts which were placed in front of you are really those or it is something else. So I think as a team trying to fundraise, one thing one should be ready for is this whole diligence. It includes financial, legal, tax, and with time it is also included now ESG diligence, because a lot of late stage funds are now driven by this agenda, and also as a society we are answerable to sustainability of mankind, right? And I think it's a very important thing. From a financial legal diligence point of view, I think it is very important for any founder to keep his books of accounts intact, keep the financial statement ready, keep your reconciliations, be it inventory, be it cash, all of that. And even your company secretarial, all of those activities, because most of these are companies. I think these help you in really finishing this process fast, reducing your efforts if you are ready to do it a little beforehand. While it is a lot of effort, and Priyanka and Siddharth, both of them mentioned on multiple occasions, and it's my role to manage and fireside most of these conversations. But this effort also has shown fruits to a lot of our founders. In one occasion, if I have to pick an example, this company was almost in the gray when it came to GST and foreign exchange management, right? Because of the way the business was structured. Now, when we found this out in the diligence, we worked along with the founders and the company to solve for this, along with some of our own tax and legal partners. And today the company is safe from all of those risks and does not carry a day-to-day, a thought that someone will come knocking at my door tomorrow, right? And all of this was done without affecting the business, and keeping in mind there is a long-term horizon to all of these companies. There is a foreign investor who may come in, who may require all of this to be in place, even if a domestic investor was ready to put in at an earlier structure. So I think this was one of the learnings. Coming to the second point of these terms and rights which an investor asks from the founders or the company. Essentially, it is broken down into 3 or 4 areas. One is operational rights. Second is rights on dilution. Third is rights on exit. Now, if I go deeper into each of these, an operational right, what are you trying to manage as an investor is firstly bring in a process, because now you have multiple people managing this, and hence you get something like an AOP to be approved by you, just to ensure that the company is doing the right set of things, running the right business, and also doing it at the scale which is the potential of that company, and also in an efficient manner. Second right, when it comes to, for example, dilution, right? Now, you don't want the company, and Siddharth has said this about Fireside, and this could be very good, very well said for most venture capital funds as well, that raising the right amount of capital is very important. Now, you don't want to cause dilution for the founders plus yourself, and be in a later stage where founder may have even lost skin in the game, right? And there is no other investor coming into the company, and you lost this money meaninglessly. So I think one of the rights we ask for is on dilution. The third one, I think this for an investor is most critical, is rights around exits. These come in form of lock-in on the founder shares, a ROFR, which is right of first refusal when someone is trying to exit, a tag-along right when, let's say, a founder is almost exiting from the company. You don't want to be left behind in a company where there's no founder unless that is your intent. So this we ask as a right. So I think these are some of the key considerations, but what would be lovely is to know what Priyanka and Siddharth felt when they were negotiating some of these rights, because I think as founders, you would be very interested to know that perspective. Priyanka, maybe you want to...
Sure.
You go first.
Okay, so let me first take both the questions, Amit, on the diligence, and then we'll talk about the rights. On the diligence, as guys Amit said, mainly 3 kind of diligence would happen: your finance diligence, your legal diligence, and maybe some cases commercial diligence, right? In finance diligence, one thing that I always say, so for us, I think we've been kind of in the right place from the beginning, literally even from before we generated even any sales, we've been using SAP Business One, which is very, very rare, and you guys don't need to use it. But my point is, keep your books right. Use some tools versus just every number being on Excel sheets, right? I think that would make your life easier when you are going through this diligence process. Right? That there are some systems which actually capture those numbers, this revenue that you're doing, inventories, reconciliations with, even if it's your D2C or Amazon or Flipkart, right? So I think make sure that your books are right. Make sure you understand, leave the investors, right? It's very important that you know what's happening inside your business, and maintaining those numbers will make sure that you know it, right? Second is the legal diligence, and I think that a lot of founders take it for maybe a little granted in the beginning, right? I mean, making sure that your corporate, I mean, you're abiding by all legal regulatory guidelines, right? In the beginning, it looks like that, these are smaller things, but trust me, as the business grows, and if you're looking at creating a business which is 1,000 crore, 2,000 crore, those things are far more important than what we can even think about it, right? You could actually have to shut down your business if you're not compliant with, let's say, one of the policies, right? It's that grave, right? And so I think those are the things that I would suggest that, which we had to take care, and we made sure that things were in place. Now, coming to the rights, yes, Amit mentioned a lot of terms and things from what obviously investor would look at, right? Now, as founders, what we went through was very, it was our first time. And actually, to be honest, first time we didn't know any of these terms. We didn't know what they mean. So what really helped us was one thing, we connected with friends who had raised money earlier on, right? It's very important that you talk to your friends who are founders of, their own businesses, etc. And you get learnings of, after your first round, you realize things that maybe you did not do the right way, right? For example, are you having operational rights to run the business, or is your investor taking every single decision making to be approved by the board, maybe? And who's the minority or majority in the board, right? Let's say if as a founder, you have the majority stake, founders including, and you're diluting only 15-20%, you would want a majority stake in the board, right? You would want the business that, to be honest, that you have built to be partnering with your investor and running it, and not in a place where your investor is running your business or is taking the decisions. And that's why I think the first question that we went to, who is the investor you are choosing, becomes very, very important, right? Right, so I think it's important for founders, one, to understand their operational rights, their rights in the board, very, very important, right, to protect yourself, right? Second would be obviously, how is your shares getting vested over the time frame, right? How much can you sell? Because, I think one thing, which to some founders it could be critical, and taking care of it, sometimes you might need money and you might want to keep a very small percentage in case of things needed for founders, right? So I think that's second. Third is obviously, when you are thinking of your next round of funding, right? Obviously, if your investor wants the right of refusal first, I don't think there's anything wrong in that, right? You've chosen an investor that you're confident with. So it's important what are the rights you're retaining in your next round of funding, so that you are not in a stage where next round of funding becomes difficult. For example, you might not want to put caps on your valuation, right? Which sometimes investors try to do, right? You don't want to close multiples, right? And block a multiple, because it should be purely a game of how the business is doing and how the market scenario is and how the market values your business, right? So I think mostly two important things, as I said. One is the commercial, how you're operationally running the business and your rights to run your own business, along with obviously your investors. And second would be how you're protecting yourself even from future rounds of investment raising, right? I think these were the two things that we kind of, little bit were kind of involved into, but I don't think we ever had to go through things which were, we felt were unreasonable, or which we thought, if you are genuinely a founder who would be invested in the business, right? you wouldn't worry about those rights in the term sheets or in shareholders agreements. But it's important that you read every single word of your shareholders agreement, or your lawyers read it.
Yeah.
Yeah. Siddharth, what was your experience?
Okay, in my case, different than what Priyanka did. We were not that well organized with. Sorry.
I asked, is it going to take you a long duration to get this answer out?
Sorry, Amit, I lost you. Sorry.
No, I was just asking, is it going to be a long answer based on your experience?
No, Amit. Try to keep it short as I can. So in our case, it was slightly different than what Priyanka did. We were more focusing on building business and actually didn't get systems in place from other parts of a DD till we realized how critical it is. And one advice to anyone would be what I'm not sure about SAP systems, and I think they did a very good step. But what I've realized is extremely important to have right set of people to manage that. Don't compromise in getting the right CA. Don't compromise in getting the right law with you. They might look damn expensive initially, but the amount of value they bring on the table is just amazing, and they take away a lot of unwanted time that otherwise you would end up wasting later on. So we have to get it right, whether it is system, but more importantly for me, people side of it. So that is one. So DD. Otherwise, if you're doing other things right, and if you have already spoken facts in all your discussions, that's another thing that I would say. When you're talking to investors, talk facts. Tell them what it is happening. Don't build up something which is not there, because it is going to come out today or tomorrow, and that is even more painful. You'd have wasted a lot of time, and then the deal would not go through. So that is what I would say in DD, in addition to what Priyanka and Amit have already said. So I'll keep it short in that way. When it comes to negotiation side of it, right? I think it is a little bit subjective depending on what stage of investment you are in. If you're talking about a seed, don't worry about too many things, guys. There are people who are trusting you, friends and family, angel, trust you, just get it in. Ensure you generate value for them. So that's the way I would go about doing it. The moment you get into a growth side of it, similar story, but again, at this point of time, getting the right partner is the most critical element, not the valuation, not anything else, just the right partner and the amount of money you're getting in. But the third side, which is probably Series B now, or in some cases, few cases might be Series A, you have to protect rights and you have to create value for everybody who has trusted you so far, including the VCs. So in this case, I think valuation becomes very, very important in the discussions because you've proven the point. The interest from the investors is also going to be high. You've done a lot of hard work to get to this point. So that's where I would play a role of from the overall set of people who are on the cap table to generate value for them. And from a founder's perspective, yeah, dilution we spoke about enough, but few things that we were very particular about was also on the this entire cause should be very watertight. You want to run the business. You don't want cause or any event of default to be something which can take away the business from you. The reality is that nobody knows the business better than founders. And the fact they've almost given their life behind it, they know in and out of it, they want to create value. They should have all the right to run it the way they want to do it with right guidance and controls from the investors. And that's why you should form all your policies and whatever the terms and conditions are. That's the way we think of it. One thing at the back of the mind is always that if you're the right investor, they are not there to do something which is not right for the business. They'll always try and do something which is right for the business as well. So they will not be very unfair, but yeah, you have to negotiate. Right, Amit? So yeah. That is true.
Yeah. No, that was very well said, well-rounded answers, both Priyanka and Siddharth. I think this should give very good insight to a lot of these budding entrepreneurs today to be able to negotiate. I'll be waiting on the other side.
Okay.
I think just to wrap up the session, if I can ask both of you to give one piece of advice that entrepreneurs should definitely take away as far as fundraising is concerned, what would be that one-liner, Priyanka?
I'll make it two-liners, Shreyans. I think two advices. One is please raise only when you need and as much as you need. not more, not early. Second is create a sustainable business that would create value for everybody in the ecosystem, your consumers, your investors, you, your employees. So create businesses that are truly sustainable.
Wonderful. Siddharth.
Probably she took mine second one, yeah. So yes, create a sustainable business undoubtedly. Secondly, don't have enough in the bank to run it till you hit the investors again. So no panic button anywhere. There are enough supply. Just get it right with the people.
Wonderful.
Wonderful. Thanks, Priyanka. Thanks, Siddharth, for making your valuable time for this session. And also thanks your stories, Brands of New India and the Fireside Ignite team for making this happen. Hope we were able to answer a lot of questions for the entrepreneurs today on the fundraise process. And if you have any further questions, please feel free to drop a line, DM us on our LinkedIn, or even email us, etc. And hopefully next time we will be back with another session on another aspect of brand building. Thanks, everyone.
Thank you so much, guys. Absolutely
Thanks, guys.
pleasure.
Yeah. Absolute pleasure. Thanks, guys.
Thank